Hello everyone, it's me, the Boss Hog, and today we're going to be walking through my portfolio as of the 20th of January 2023. A slightly different format this week where we're just going to be going straight into my dashboard, hence the change in visuals here to look at my profit over time, one of the graphs from my dashboard. And we're also going to be talking about some politics, some macroeconomic change, some news basically that I think is particularly newsworthy. And then we're going to do a part 2 video where we start analyzing companies, looking at news in a bit more detail than we've done previously. To me, it just made a bit of sense because some of my videos have been like 40 minutes to 60 minutes long. That feels quite long to me. And so we're going to break it down into these two segments. Let me know how you find it, whether it makes sense, and we'll have a look at viewing figures, see if people are getting any value, and go from there. Let's do it. All right, so in terms of news this week, there was definitely panic in the UK's YouTube channels focused and UK focused discords from an investment perspective. The main reason for that was because a left-leaning think tank called Resolution suggested that it would make sense to cap ISAs, so individual savings accounts, to 100,000 tax-free, presumably as a lifetime allowance, similar to sort of pensions being just over 1 million. Certainly for me personally, this would be incredibly disruptive to the point that I would definitely reconsider locating elsewhere, because it wouldn't make sense to me to be a resident of the UK for ISA purposes at that point when I could save my income tax elsewhere by relocating. This would be significantly detrimental when I'm looking to have about 2.5 million in my ISAs when I retire, and it would ultimately mean that I was paying something like £50,000 a year in tax if this policy was implemented. It would be extremely expensive for me and would force a change, and therefore I think it's slightly disingenuous for Resolution, this think tank, to claim that it would bring in £1 billion, because there's an assumption that the people that would impact wouldn't make any changes, and I can tell you personally that this is the kind of change that would make me have an impact. This would be really significant and would just encourage me basically to relocate to elsewhere. I was sort of half joking that I would just go to Portugal, which has a sort of 10-year foreign income tax free period for residents, right? That to me would then appeal, because at least then I could keep my income tax currently, which is several thousand a month and about 30,000 a year, instead of the ISA. That would basically be my approach to do this, and we would go from there. However, I just want to be super clear that this is just a think tank. Think tanks on both the left and right come out with interesting proposals all the time. It's definitely not the case that either part of the political spectrum is a monolith. There are differences of opinions within Labour, Conservative, and etc. And ultimately, these kind of think tanks are trying to nudge discussions and policies in the directions that they favour, right? So I think right now, although it is somewhat alarming, I think we should also bear in mind that this is several years away from being a realistic proposal in terms of policy. I would very much expect it to get watered down. This would impact the kind of aspirational middle class that both parties are trying to win, and kind of a battleground between both parties, I would suggest. I'm probably more naturally leaning Conservative, but again, I think sort of these are the sort of votes that Labour would need if it was to get back into power. So right now, although it's concerning, there's no need to believe that this is going to become policy tomorrow. Obviously, that if there are changes, we'll discuss it and we'll reconsider as and when that happens. But right now, it's sort of calm. It's a proposal from a think tank and nothing more. I also wanted to talk about this because I think this is pretty ridiculous, that the Bank of England declared that we collectively are winning the battle against inflation. And the reason for this is because it fell sort of 0.2%, but it still remains over 10%. Core inflation, which actually strips out more volatile changes like energy and food, was actually up. And it's just clear to me that we need to raise our base rate much more aggressively. It's actually the reason this week why FX movements was so negative for me personally. There is an assumption that the pound is going to get stronger because the interest rates are going to have to go up a lot more aggressively than the dollar counterpart. And I think that makes tons of sense to me. That's very logical. So at the moment, pound is much stronger than I'm expecting it to be across the course of this year. Or I expect it to be like 115 to 120. It's kind of in the 124 region. So that's definitely had an impact also. And I think, to be honest with you, like the market's been more right on this than the bank has. I think they're woefully slow, and the concern here is that basically if they move too quickly, they'll cause a recession. But not moving quickly at all and having inflation run like this will cause recessions because people won't have any money to spend. So guess what? And also it's starting to have very real political impacts, right? We have a lot of strikes going on at the moment where particularly public sector workers just don't have a situation where they're easily able to get pay rises. And as a result of that, they're demanding more pay rises. They want more money because they're seeing their living standards decrease because of inflation. So you're ending up with what could have just been an economic problem now becoming a civil and political one as well. So to me, it's ridiculous that like the Bank of England is crowing about the success. I don't see it. I'm pretty sure not many people see it, and everything still feels very expensive, right? So I think it's just ridiculous. It annoys me, and I want to call it out for what it is. Next up, and part of the reason for this as well, we're calling this episode what I did, is because the markets this week were pretty much all over the place. It was quite red for the middle period of the week, sort of green the beginning and end. My UK positions largely held up okay. It would have been flat if I just look at my UK positions in isolation. And to be honest, again, if I strip out the impact of FX, that also would have been flat for my US positions as well, which is somewhat surprising. But it was a challenge, I think, trying to work out what was going on. I think, this is a sort of irreverent comment to take the mickey a little bit out of people who read lines and sort of see patterns. As a slight anecdote and segue, sometimes when I go to the casino, I play with Baccarat players, and for anyone who doesn't know, like Baccarat's basically a coin flip. It's got some of the best odds in the casino, and the Chinese especially love it. And like all of the previous deals are on the screen in terms of who won, right? Whether it was a tie, and they're desperately searching for patterns in effectively randomness, right? And not quite isolated events. There is some, but again, any sort of study would be similar to like card counting. And it's just, that's not the tool, or the data is there to allow you to do any kind of this. And even then it would be so marginal in the times of the cards being used that it wouldn't make any difference. So it kind of reminds me it's very similar. So I just want to talk about that. But really, if I talk about investors specifically, right now it's a case of a lot of the data hasn't really changed people's opinion. Like I feel like if you were a bull before, you'll still be a bull. If you're a bear before, you'll still be a bear. Now, I would just say that the retail figures for December came out were pretty shockingly poor in quite a few areas. However, we had like 10 days of snow, really heavy snow as well, really poor weather. We were heavily disrupted by sort of things like postal strikes, which again meant that even online shopping was down this year as a percentage of total. Lots of strikes, as I've already touched on, and weather, etc. So for me, I'm not convinced that December in isolation is a particularly good measure. November also outperformed, and there was some evidence, certainly in things like food retail, as well as gift buying, that people actually brought it forward a little bit. So November was slightly better than December would normally be. So likewise, it'll be interesting to see what happens with January, whether people were like busy buying discounts, whether now that the weather was slightly better and there were fewer strikes, what the situation was there. So that there's like, and likewise with the earnings as well, like some companies are doing really well. Definitely though, some companies have disappointed, and like a lot of the share price reaction has been quite immediate and high. You've seen like plus 10%, minus 10%, right? Announcements with mass layoffs are usually met with cheers because it means the company's getting on top of costs, cruelly but understandably, right? And there probably is, in all seriousness, to people who do trade, there probably is some money to be made from sort of backing yourself and taking big bets, right? It's probably a high risk, high reward kind of setup at the moment because graphs really are volatile, even on very large companies, like tens and even hundreds of billions is being sort of changed on a weekly basis on their value. So there's definitely money to be made, but you sort of have to ride the variance at the moment. So that was interesting for me from that perspective. I just want to touch on this because I feel like it is somewhat related, and I'll explain why in a second. But a government-backed EV gigafactory went bust. Now, officially, name of the company was British Volt, but everyone just calls it Gigafactory because I guess it sounds pretty epic. The motto did make me laugh, considering it's just gone under, with powering the future, which is just timely considering our current government doesn't seem to be able to do much planning or etc. Um, the reason why I really wanted to raise this is because to me it kind of builds on a frustration that I have with not just our current government, but really British governments of all colours, where to me it's not clear what our philosophical approach is in terms of do we back winners or do we back the market? And like when I like as an example, right, a few years ago, Rolls-Royce had these small modular reactors, and everyone was very excited about them, right? These are basically miniaturized nuclear power plants with a very small footprint, really efficient wastage. You know, there was potentially a market, right? And it was just like there was no backing. It was a case of, well, the market will decide, right, etc., etc. Even though there was a clear need to kind of have energy independence, which is now biting us, and a clear opportunity to sort of sell a British company with strong engineering and technical skills, basically, right, that already has nuclear experience from providing the nuclear deterrent and the submarines and engines and everything else. So it's already got that kind of facilities in place, and it just wasn't interested at all. And likewise with this, the government sort of went through situations where sometimes it was really keen on the idea, but then it wasn't really willing to stump up the money, and it kind of begrudgingly put in 100 million and sort of a £4 billion project, and it just felt really incomplete and like they weren't really sure what they were doing. And for me, to be clear, I'm more of a market person. Like for me, if there is a need for these kind of things, then the market should take care of it. But first of all, there's definitely a political angle here, right? Like being the first to move, getting the scale of an entirely new industry effectively might require and justify government involvement. That is a benefit of central planning, to kind of bring stuff together and think strategically in a more targeted way than maybe you would get from the market, at least in the short term. But the whole point of a market, of course, is it's meant to be efficient. So in the long term, it should kind of accurately dictate where investments, etc., go. But I guess I'm just slightly envious because, like, if I look across the sea to France, France is a country that does back winners, right? Like it does get actively involved in a far different way, but it is absolutely able and willing to back multinationals, win contracts. It will very actively take things like golden shares and seats on boards and that sort of stuff, because and that's okay, right? That's the position that they take, and they're philosophically consistent. Whereas I feel like we're not. It's like, what are we here? Like, are we a centralized planning kind of country, or are we a market driven country? In which case, why are we getting involved in this stuff in the first place? And again, if there is a justification for getting involved specifically in this type of project, then let's do it properly, right? Chuck a couple of billion at it. It's not even that much money to the UK. Like 100 million is just, it's not going to do anything. So I just, for me, it was really frustrating. I have an ultimate sympathy for the 200 plus people who've just lost their jobs. I do understand from reading that the company was riddled with poor management, wasteful spending, and everything else. But again, that's just indicative of funding and in backers, both private and public, who didn't really have a tight handle on what was actually happening. For me, you know, like I've worked in private backed companies before, but they were private. And the shareholders were very close to it, right? Like they would absolutely pull up senior management teams with a kind of wasteful spending and interrogate things like senior hires, expensive investments, etc., etc. It did get sometimes actually really invasive and uncomfortable. So to me, it's really frustrating that like the government puts in not nothing, but not enough to really own the project, doesn't seem to manage it at all, and then it goes and it's just a waste of like 100 million quid, which is just shocking to me. And ultimately, yeah, frustrating, and it just is a wasted opportunity for this. There is a rumor that a couple of private companies are also considering sites, one from America, one from China. We'll see what happens with them. But again, if that does happen, then is there a conversation now for talking about the market? Should we have never got involved in the first place? I don't know. So I just wanted to talk about that. I think it is relevant, and now we'll do our portfolio walkthrough as per usual. All right, so a couple of things to highlight this week. First of all, we put in a couple of £1,000. I do have a little bit of cash in the bank and have been keeping it by just in case. But as we get close to the end of the month, it was clear that we're in a situation where I could release it basically. So I did do some buying this week, and we'll get to that in just a second. We also had a couple of dividends that came in, and again, we'll get to those in a second. Overall, though, to be honest with you, not a particularly great week. It was a bit of a mixed week, to be honest. Like if I go to my day end figures over here, You can see here, like, this week has been sort of all over the place, really. And within that, you know, the US was particularly rough. And to be honest, impacted by really unfavorable FX movements. I definitely was down about 2,000 this week, just in terms of FX movements. Roughly speaking, for every cent that it gets weaker, it's worth about £600 to me. So, you know, sort of 3 and a bit cents is worth the better part of 2,000. So, to be honest, although the headline figure here is that we were sort of down 2,000 without topping up, actually I was really happy because you'll see in a second as well that some of my bigger holdings gave back some of their recent gains. I was running into the FX movements, and so broadly I was actually kind of quite happy this week with my overall performance. That said, if we look over at the graph on the right here, I did fall back slightly against the FTSE 350. We continue to struggle to catch that index as a benchmark, but broadly I'm still okay with how we're performing there. And likewise, well, my portfolio value kind of looks flat week on week, but that's only because, again, roughly speaking, my deposits were equal, give or take, to the performance of the portfolio. So not a huge change on this graph really across the week, just slightly less blue than there was previously. And similarly over here as well, this one I think shows it a little bit better, specifically because this is only looking at profit. So you can see actually like my US positions especially gave back a lot this week. That's really an emphasis on the FX situation, whereas my UK stocks are actually continuing to actually hold up quite well, and I'm hoping one day to become profitable, specifically on my UK holdings once more. Made some changes down here. So first of all, I have now introduced conditional formatting. The way that this works is any movement plus or minus 3%. That is an arbitrary number, but it felt about right and gave me sort of a reasonable sort of change week on week to talk about. I do find it very telling that if you look at year on year, bearing in mind this is 11 months after the Ukraine was invaded. So you're sort of still comparing beforehand. I'm kind of expecting that as we go into February and March, and then we have tougher comparables year on year, that actually this is all going to start to turn green as we sort of start to recover from that situation. Likewise, similarly, the month on quarter change is broadly green across the board. There are a few exceptions. Some of the big tech, like Amazon, for example, still remains pretty red, but you can see broadly it's quite good. So that's positive. I would definitely say that this, has momentum if you're one of those kind of investors / traders. I'm not necessarily, but it's still super interesting to see the very clear direction of travel here. In terms of my buys then, first of all, so I'm going to start here with this. So it got a majority of my 2,000. There's a weird rounding issue with my brokerage this week, so this ended up with an extra penny. But effectively, this is my big tech ETF. Its largest 3 positions are Microsoft, Apple, and Google in that order. It's also within the top 10 got positions in TSM, Taiwan Semiconductors, as well as AVGO, Broadcom. And on top of that, it's got a couple of Visa and MasterCard in terms of payment providers. And likewise, a couple of companies I haven't really heard of before as well, but one of them, Paycom, was really interesting to me. I did a little bit of research into that. I think it's got some really great numbers, and it's kind of one of those companies that it's nice to hold that I probably would never have found if I wasn't buying for an ETF, so that feels quite good. But my plan here really is to buy this under 220 as much as possible. I'm up very fractionally at the moment with a 208 average for my entire holding, and I just want to get as much money into this as soon as possible. It's discounted by about 12% against its net asset value, and I think it's like how I want to be gaining exposure to big tech as part of the recovery, so that felt good to buy a position here. Slightly buying ahead of my average, but honestly, I'm completely fine with that. Then we go down to my REIT ETF here, and again, we are very modestly green, but more or less break even on this. So this only got £250, give or take, this week. And again, it's perfectly okay. My average here at 40.06 is, slightly ahead of where it finished for the week, but my overall position is materially flat. And then lastly here, to give myself some healthcare exposure, we've got 500 into my world healthcare. I would describe this as like mature healthcare ETF. It took me a little while to find this one, and it is a synthetic ETF rather than a true one, or traditional one, I guess. But again, I'm absolutely fine with that. Slightly more risky maybe, but again, I'm okay to have a little bit more risk in my portfolio with ETFs. considering I'm going to continue to buy them. In terms of my dividends this week, so I reinvested both of them. First one into Micron. I would say Micron because of the very disappointing quarterly results that it published. Hasn't really rebounded as much as some of the other stocks in the semi space. But I'm still really confident about the long-term nature of Micron. So I'm very happy to average down. I'm down about 8% at the moment on my position. And with DLR here, Digital Realty, I'm actually down quite materially, close to 20%. But again, I'm more than happy to keep averaging into this. I kind of buy into the long-term necessity of data centers and think that, companies aren't going to build their own on the whole, maybe one or two. In terms of major movements, we had an interesting situation with some of the big tech where they've been announcing sort of mass redundancies. The market's broadly responded quite positively. You've also got sort of Meta in this list as well. I'm sort of surprised that Microsoft finished the week flat. But yeah, that's interesting the way that the market reacts to these things. Amcor down 5%. Again, it gave back a little bit of its win. This is still my largest holding, just about, even after the fall. And honestly, it's run up so much that it's okay. And the fact is, again, that we're sort of still progressing in our portfolio, despite the fact that this 5% is equivalent to 1,000, give or take, slightly under, but yeah, it's a significant change just for that one. This is a very small sort of consumer goods company. Not too much to talk about, really. It's got very big spread, so it can be quite clunky in terms of how it moves. I do just want to talk about Hollywood Bowl because I finally think it's getting the love that it deserves. I've been really bullish on this for a long time, and I feel like the results were just fantastic yet again. Really strong dividend, really well-run little company. It is a penny stock in the retail space, which sounds quite terrifying at the moment, but what we're seeing increasingly is that people are spending money on experiences, and to me, bowling represents a really good family entertainment that's difficult to replicate at home cost effectively. So it's starting to get a bit of love now, which I think is completely justified, and I'm really pleased how it's performing. We are up very significantly on our Hollywood Bowl stake, about 25%, and I've also sold in the past as well very nicely, so definitely turning into a real winner on the Hollywood Bowl side of things, so that feels great. Clean energy here, it's just an ETF. It does exactly what it says in the tin. I don't want to talk about it too much. Kingfisher likewise is sort of how I would describe sort of Home Depot in the UK and some parts of Europe as well. It's actually, I would class this as a bit of a recovery and turnaround stock. It kind of lost its way a little bit with sort of inventory management and sprawl more generally. But I still like it. I'm up sort of about 5% on this currently. It has recovered and stabilized after some analyst downgrades. But I still kind of buy into it in the long term. So again, no real concerns with the drop there. Polymetal is meant to be my silver and gold hedge, but because of its Russian exposure, it has not performed very well as a hedge. It's gradually recovering, but it's got a long way to go to get to the level where I was buying it at for sure. Scottish Mortgage is my, I guess, smaller tech ETF. It's highly volatile, highly risky. It was in the news this week because more than 30% of its holdings are in private companies. That's only the second time in its history that that's happened. And there is some worry that the only reason that is happening is where the private companies aren't being revalued correctly or quickly enough. But the big companies, the publicly traded ones, of course, they get revalued every day in real time, right, on the market. So there is that concern. I think that was kind of weighing on the sentiment more generally. I'm down modestly on this, just over 10%, but I will continue to average into it in the short term. But I'm just mainly focusing on AAT at the moment from a tech perspective for sure. And then Disney, again, I continue to sort of point people in Joseph Carlson's direction. I think he's got a good grasp of the issues with Disney as well as Peltz's summary, which again I think is on point. And so I think it's good to see Disney sort of stabilizing in response to that. I'm hoping that it's going to sort of force management to reevaluate themselves and go from there. Because the Disney brand is just so powerful. I would say other than Apple, there isn't, they would be like in the conversation for the best brand globally. I think it's superb. And yeah, it's up there in terms of your Apples, maybe your Starbucks, that kind of height. So with the buying, basically, we added a little bit to our healthcare now at 1.2%. I really want to get my healthcare to at least 5%. So again, I'm going to mainly be doing it through this X-Trackers synthetic ETF here. We are also building our tech segment as well. and then our REITs are just increasing slightly, so 5.8% once we count the stuff in the ETF. Dividends now are more or less in line with expectations for the month, so I'm not expecting any more for the month. Actually, I got fractionally more than I was expecting just because of some dividend increases, as well as some favourable FX when I got it like slightly better than I was expecting when I was running the numbers. But more or less here in line with expectation. We'll see if I continue to guess right as the future unfolds. But yeah, again, so that's my last dividend for the month, but takes us up to 51.73 overall. Again, feels really good. And outside of that, not really much to add. So what I'm going to do with another video is I'm going to separate out that video to talk about companies that I'm following and any news and anything from that perspective. So let me know if you like the fact I split this out. I just think it makes a lot more sense rather than doing sort of 40 to 60-minute videos. We'll have a portfolio video week on week, as well as sort of some headlines from an economics perspective. And then we'll do sort of a company breakdown where we'll start to hopefully get a little bit more professional, start doing some model and go from there. Anyway, I quite enjoyed this week. On reflection, I feel really positive about it. The fact that we were able to navigate some FX movements, the fact that some of our bigger stocks had a down week and we still basically trod water, and we've added some more money again as well. So actually, I feel really good about this week. I'm more than happy now to be buying in a falling market, and we will continue to just average in and trust the process, basically. Hopefully everyone enjoyed that. Thank you very much for watching. I've been the Boss Hog, and good luck with your investing. Bye for now.